Good morning, everyone. Welcome to this update for global stocks for the 24th of April. And in the middle of February, I didn't believe that I would be saying this so soon, but it would appear that the odds have certainly swung more bullish thanks to the quite amazing rally that we've had from the lows in mid-February. And not only in stocks in general, but also in commodity prices and also several other key asset classes as well. So it's certainly been very much an attitude of risk on again, that's for sure. So let's jump in and have a look at what transpired in the last week. The S&P index was higher by 11 by the end of the week, although certainly the trends higher are only edging forward now at this stage. So the trend remains pretty bullish, and you certainly wouldn't want to be betting against the trend. But it's definitely running on oxygen at the moment. Now that doesn't mean that we're going to get a significant correction, because we may not. But certainly this is not a point where you want to be buying into the general market at this stage, except for some select sectors. Now, interestingly, the technology majors had quite a poor week. Facebook, Microsoft, a whole lot of those sort of technology majors, and that's really quite interesting because the Nasdaq normally does lead the general stock market. So I'm just wondering, whether we're getting a bit of an advance notice of a bit of a turn down in the market, and I find the timing interesting as well, because quite often the period starting in May is often the weakest period of the year. The Russell 2000 small caps outperformed all other sectors, outperformed the Dow, the S&P. So those two things aren't really that consistent. So we're certainly getting some very mixed signals at the moment. So the question on my mind is, what will be the catalyst for the next leg up? You can't feel really confident about a downturn because this rally has been so strong. But I'm actually struggling to identify what the catalyst might be to actually get the market to move above this trading range that's been in play now since 2014. And with earnings as they are, with the global economy as it is, with the American economy as it is, it's really hard to see what that catalyst might be. But anyway, markets exist to surprise us, I guess. Australian stocks, the Aussie dollar spiked up above 78, certainly in part due to commodity prices, but finished the week in the low 77s as we had a bit of a turnaround in the US dollar on Thursday and Friday night. Now the ASX 200 rocketed higher by about 80 points for the week. There are a few renewed trends emerging in specific stocks, but there's really nothing on a sector-wide basis. However, keep your eye on BHP and Rio and Woodside to a degree, because they're certainly showing signs of moving out of a base and perhaps going back into a phase 2 bull market. I'm going to have a couple of comments about that in the next slide. But it's certainly a bit unexpected if you're working off logical conclusions about commodity prices. But generally, the Australian market, we're lacking medium-term trends. I think the vast majority of stocks, they're just going up and down, and there's really no net gains over time. So let's take a look at those few charts to start with. So we'll start with the S&P, and you can see that we had this consolidation period here that lasted from the 18th of March until the breakout on the 13th of April. So roughly 4 weeks. Since then, we've gone up and gone back, but you'll notice that the daily ranges are quite small. There's nothing all that definite about the way they're finishing. We're getting quite a mixed outcome. So it's really, as we approach the all-time highs, and we're within 2% of the all-time highs in the S&P, the market really does seem to be struggling a little bit. Just taking a slightly broader view, we've been looking at this monthly chart now. Just excuse me a sec. Pardon me, you'll have to excuse my cough. Looking at the S&P on a monthly basis, you can see that we definitely had what looked like a significant character change, but the rally's gone so far back up now that it's hard to cling on to the bearish case being the predominant one. I think you've got to be at least mildly bullish. But as I said, I certainly wouldn't be buying it at this level because I think we are due for a bit of a downturn. Now let's look at the Russell 2000. So you can see finished quite strongly on Friday night, finished right on its highs, still clearly an uptrend, whereas the S&P in the short term may be kind of peaking out and rolling over. And if we look at the NASDAQ index as well, you can see it was sharply down. So yeah, it'll be instructive to see how this all plays out over the next week or two. Turning now to, we should just have a look at the Australian indices and also have a look at the VIX index. Now, you can see here that we spiked up several times. We spiked up in August of last year when there was a little bit of a mini crash. We got up to the high 30s, fairly quickly came back down to this area of basing, which is around about the 13 to 16 area. We had a couple more spikes in January and February when the market got very nervous about the Fed raising interest rates and also about China. But you can see that we've been down in this 13 or 12 to 16 range now for some time. So, there's really very little fear in the American market at the moment. It's very much risk on. The ASX 200, just for the record, we did have a downtrending channel. We've broken that downtrending channel, but we're still within this base. So we really need to break above 5,400 to signal any chance of a renewed uptrend. So we finished the week at 52.36. So we need at least stack on another 160 odd points at least to get a breakout and signal some sort of renewed trend. And I'm struggling to see what the catalyst for that would be in Australia, that's for sure. Now, just have a quick look at the Australian dollar. So we did spike up quite well, but we still haven't exceeded this big downsloping channel in the Australian dollar. We got quite close, and it's possible that we may work our way a little higher. Perhaps might just make it to 79. But there's going to be some significant resistance at that level. And if the dollar then moves back to its other extreme, then we're certainly looking down in the mid to low 60s. So you've got to look at that chart and say, well, that's the overwhelming probability. Also, we haven't got above this peak back here yet, which occurred in May of 2015, and that's around about 81 cents. So we're going to get resistance around 79 and then again around 81. I doubt very much whether it's going to be able to sustain these levels for very long. Turning now to commodities in general, and I want to make a couple of really key points before I get into the specifics. Prices of commodities will bottom before the fundamentals improve. In fact, most times you're going to see commodity prices bottom and start to turn up, and you can only really determine this 3 months later when you can look back and observe that a bottom has occurred. But what you generally find is that the bottom will occur when the fundamentals look absolutely grim and disastrous. And you certainly have to say, with iron ore and oil and copper, the circumstances look quite disastrous at the moment if you're just looking at supply and demand. And that's why I've been pretty negative on it, and I've kind of realized myself that I was probably placing too much emphasis on the logical supply and demand conclusion and forgetting about the fact that markets do look forward, and generally the bottom will be when things are the grimmest. And we're certainly looking that way at the moment. So markets do look forward, always. Markets are never looking backwards. They're never looking at the current time. The second point that I want to make is that you've really got to just ignore conventional wisdom. If there's something that you've been clinging to as an idea that always is, there's been a real school of thought around that when the Fed starts raising interest rates, that is bad for the price of gold. Now that's conventionally accepted wisdom. The only problem is it just defies the facts, because in any interest rate rising cycle, gold does really well for at least 2 years, and stocks do really well for at least 2 years after that interest rate cycle starts to rise. So even though it's conventional wisdom, it's actually completely wrong. So it's really interesting how those things get, start to take root and people start to accept them. So I think more than ever now, you should ignore conventional wisdom, question everything, don't accept anything as a given. Now, the next point I want to make is that the best money-making opportunities always defy logical consensus opinion. So if something makes sense, then it's it's probably not a very good money-making opportunity. You've really got to be a contrarian these days. Commodity prices are not just about supply and demand. They also depend to a large degree on money supply. In other words, how much liquidity and how much money is in the whole global system. And the facts are that the amount of money circulating around the world is 300% higher now, or in America, I should say, is 300% higher than it was in 2000. Now, that's an enormous increase. A trebling in a decade and a half is quite staggering. And so all of that excess money sloshing around the place, part of it has gone into stocks. Some of it went into housing in the early part of the last decade. And now it's finding its way into commodity prices. Pardon me. The next point I want to make about commodities in general is the volatility. There is always going to be a lot of volatility associated with commodity prices, and even more with commodity stocks. But you can get highly profitable rallies that you can trade even without going into a new bull market. And that's why I haven't been too fussed about whether gold breaks out or not, because we've got this phenomenon that I've spoken about several times, and that is that the prices of gold and silver stocks are at extraordinarily low levels compared to the underlying metals, and that they could triple or quadruple without the underlying metals moving at all, just to restore a level of normality. So we can see some very highly profitable rallies occurring in those stocks, but there will be what I would term some conviction-shaking retracements occurring. That there will be retracements that will scare the socks off you, that will make you think that this is just another bear market rally. This is not the real thing. And hence, that's why it's so important that unless you're highly experienced in the market and you've been through these cycles numerous times before, it's really, really difficult to do this on your own. It's not just a matter of picking some stocks and sitting on them for the longer term, because I can promise you that your conviction will absolutely get shaken on a semi-regular basis. So it's fine to look at a bull market that occurred 5 or 6 years ago and say, well, it went from point A to point B and it made 300% or 500% or whatever the number is, and I could have just bought here and sold there. It's living with it in the middle that's the really difficult part. Now, turning to precious metals, significant corrections will occur, as I indicated. Over the last week, gold was flat, so the price of gold didn't move. Gold stocks were up by about 2%. They were doing better than that until we got a pullback on Friday night. Silver was up 4.3%, so silver is starting to outperform gold, and I showed some charts on that last week. But silver stocks were up by 8.4, so by nearly double. And if you want to track what is going on with silver stocks in general, so this is just a global ETF, then the code is SLVP. But it's not something I would trade because within that ETF, you're going to have an enormous divergence in performance. There'll be some silver stocks that, in fact, there are right now, there are some silver stocks that haven't moved, yet there are other silver stocks that have gone up 800 or 1,000%. So it's still very much a stock picker's environment. And of course, gold and silver stocks are just really going to amplify the gains that we get in the underlying metals. I honestly believe that, and I've been just reading everything I can get my hands on, doing a lot of my own research, and I've become fairly firm in my idea that, or my belief that this is a real generational opportunity. This is the sort of thing that only comes along once every decade or two. I think the opportunity in gold and silver stocks is that big. You may only see a couple of these in your lifetime, so you've really got to get in and take advantage of them. Most people miss them because they come after a significant bear market. And during a significant bear market, everyone has their conviction and their enthusiasm for that sector completely destroyed, completely chopped up. And human psychology is that you then demand a lot of evidence before you'll get back in. And we're still in that stage at the moment. There is still a general disbelief in this rally, even though the gold stock indices have nearly doubled in the space of 6 or 8 weeks. The vast majority of people are still dismissing them, and most analysts are as well. There's still an awful lot of sell recommendations out there on gold and silver stocks. So copper rose to $2.28. So it's rising, and that was interesting because the US dollar actually went up a bit in the last 2 days. So copper is rising against the trend of the currency. So base metals are now joining in the general rally. We also saw some good gains in zinc and tin as well. We saw crude oil higher to $43.70. So just refer back to my earlier comments about the fact that commodity prices will bottom out when the logical fundamentals of supply and demand look the worst. I'll put my hand up and say that I've probably been focusing a little bit too much on that, and not as much on what we're actually seeing right in front of us right now. And there's no question that the price of oil seems to have formed a base and is moving up, and oil stocks are starting to move up. Iron ore, although I don't believe this one's sustainable, but iron ore is now close to $70 a ton, and a number of other commodities as well. So it's quite likely now that we've seen the bottom in commodities. The market is looking ahead, and even though the fundamentals look awful, that we're going to continue to see a bit of an uptrend. There's the spot copper chart. So let's backtrack and have a look at gold. So we'll start first of all with the US dollar. Price of gold. So that's in on a daily basis. So you can see for the week, didn't really do much. We had a nice surge on Tuesday. We had another really good surge on Thursday. And there's quite a bit of buying coming in through Shanghai now, which is interesting because that corresponds with the fact that the Chinese have now started participating in the fixing of the price of gold. It's not just happening in London. But we gave some back on Friday. I think that was largely currency related because the US dollar moved up. So I think that's all that was. Let's look at silver. Just ignore this big spike here. I think there's a piece of stray data in my software. So just ignore that. Certainly the price of silver didn't get up to $21, but you can see that we're definitely seeing some improvement in silver, and the fact that it's going up faster than gold is a really good sign. Let's look at the HUI index for gold stocks. They managed to break through a key resistance level. So we had a really important resistance level here at around 200. It managed to get just above it, pull back a little bit, and look, we've had such a run that a pullback has got to be a given. The only question is how much. Will it just be a little bit, or will it be a bit more significant? And obviously, no one knows the answer to that. All I can tell you is that this trend that has emerged here since the end of January is the strongest trend in a number of ways that I can find going back 40 years. So this is significant. This is not just another rally as we've had since 2012 that's going to peter out. And that's why I think this really is a generational opportunity. Now, I did mention an ETF on global silver stocks. This is it, SLVP. If we pan back, you can see that it formed a high up around $27. We got down to a low of 4, and you can see that's been a fairly dramatic move. So from the absolute bottom, which was on the 21st of January at $4.50, we touched $11. So that's a pretty amazing move. But as I said, I certainly wouldn't be trading that. I'd be looking at individual stocks, and I have a number of them that we're currently trading, as members will know. Okay, so just to wrap it up, a US correction from May is still a possibility, but absolutely wait for it. Just trade what you see. Don't go short until you see the evidence that the market's turning over, because it may not happen. We may break out into a new all-time high. So I don't dismiss that as a possibility. Commodity stocks, though, where the opportunities really reside, in my view, but large volatility is just an absolute given for the sector, which makes it difficult for the inexperienced, because it will shake your conviction, that's for sure. So the importance, and I said this last week and the week before, you must have a predetermined plan if you have any hope of trying to survive and profit in this market. So that's it for this week. Anyone who's not a member that would like to contact me, there's my contact details, and I'm sure we'll have another very exciting week. Cheers.